Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the US dollar index and the euro currency for Friday, June 15th. Starting off here with an intraday 4-hourly chart of the US dollar index. You can see this week's resumed erosion of last week's initial counter trend break that certainly confirms at least the short to intermediate term trend is down, and most importantly defines the 82.73 high from this past Tuesday the 12th as the key short-term risk parameter this market is now required to recover above to arrest this sell-off and confirm it as the three-wave and thus corrective sequence within a broader bull trend we suspect it is. So I'd like to emphasize the importance of that 82.73 high as a short-term risk parameter, especially heading into this weekend's vital Greek elections that are likely to have a major impact on the currency markets and indeed a lot of the markets globally. While the market remains below 82.73, shorter-term traders with tighter risk profiles remain advised to maintain a neutral to cautiously bearish policy. From a longer-term perspective, however, and why we suspect that the past couple of weeks setback attempt is merely bull market corrective, the daily chart here shows the magnitude of the broader bull trend and the fact that it's thus far only pulled back to an area of former resistance turned major support, that former resistance from January 13th's high, the upper 81 handle. It's also notable that the 81.65 level is the 38.2% retrace of our May's suspected third wave rally from 78.60 up to 83.54. Thus far, this setback attempt is a classic corrective deal, and we advise longer-term traders to maintain a bullish policy with further proof of weakness not only below this area of former resistance new support, but below the May 21st next larger degree corrective low at 80.90, sufficient to threaten that broader bullish count and expose a much larger degree peak and reversal threat. Moving to a longer-term weekly log-scale close-only chart, you can see the magnitude of the major uptrend in the US dollar index dating from April of 2011's low weekly close at 72.93. Now, admittedly, the bullish consensus measure of sentiment according to this market at a recent 73% reading, is the highest since June of 2010. That's the type of historic bullish sentiment that is typical of broader peak and reversal environments. So therein lies the importance of a little bit more proof of weakness below this 81 handle in general and below 80.90 specifically. If we can get that weakness combined with this market sentiment, some of the factors are in place for a much larger degree peak and reversal threat. These issues considered, longer-term traders remain advised to maintain a bullish policy with weakness below 80.90 required to threaten that view sufficiently to warrant moving to a neutral sideline position ahead of a much larger degree peak and reversal threat. While the market sustains prices generally in an 81 handle, we advise them to continue to approach this setback attempt over the past couple of weeks as merely a fourth wave bull market corrective sequence that ultimately will yield to the longer term bull trend and new highs above 83.54. Shorter-term traders, by the same token, are advised to maintain a neutral to cautiously bearish policy out of deference to the clear and present short to intermediate term downtrend with strength above Tuesday's absolutely key, short-term but key 82.73 minor corrective high and short-term risk parameter, the market's recovery above which will confirm our suspicions that this sell-off attempt is indeed a three-wave and thus corrective sequence within the long-term bull trend. We suspect that above that point the market should trend very impulsively to new highs and potentially significant highs above that June 1st high at 83.54. While the market remains below 82.73, further erosion, perhaps even accelerated losses following that Greek vote on Sunday, come Monday trading next week, should not surprise. Similarly, looking at an intraday 4-hourly chart of the euro currency, you can see this week's resumption of last week's initial counter trend recovery attempt, and by virtue of the extent of the past few days' recovery, we believe the market has defined the 124.43 low from Tuesday as the latest corrective low and tightest risk parameter this market is now required to fail below to render this recovery attempt over the past couple of weeks a three-wave and thus corrective sequence consistent with the longer-term downtrend shown on a daily log scale chart here. Indeed, on this logarithmic scale, you can see the market's return to the 38.2% retrace of the May decline from 132.84 to 122.89. That is also receiving resistance support from the former area of support from June 16th in the lower 126 handle area. That former support turned new resistance, combined with that 38.2% retrace, and within the context of the longer-term bear trend, clearly to this point, this recovery attempt falls well within the context of a broader bear market correction. And on this larger degree scale, we believe a thorough break above the 126 handle in general and above the 128.25 corrective high from May 21st specifically is required to warrant to break this or threaten this longer-term bearish count enough to warrant longer-term traders move to a neutral sideline position. Moving here to a weekly log scale chart, you can see the significance of that former support term resistance from the upper 126 handle from back in January. Also the magnitude of the long-term bear trend. Clearly strength above at least this 126 handle on a weekly close only basis is required to threaten a broader base and reversal threat. The sentiment accorded the euro currency is historically low and in keeping with the types of sentiment that is typical of broader base and reversal threats, but we simply need a bullish divergence in momentum of a scale sufficient to break this longer term downtrend, and we believe that that's going to come on proof of strength above 128.25. These issues considered, shorter-term traders with tighter risk profiles remain advised to maintain a neutral to cautiously bullish policy, with weakness below 124.43 required to confirm this recovery attempt as a three-wave and thus corrective sequence within the broader downtrend, warranting a move back to a neutral to cautiously bearish policy below 124.43. For longer-term traders, a bearish policy remains advised with strength above 128.25 required to take defensive measures. Please stay tuned to updates on these and other markets on our RJOMRT.com website, and good luck with today's trading.